to the extent crypto has intrinsic value, to me, it is the developers, the code base, and the users that it has today. And that is a valuable resource.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. Some of you may have been listeners to the ETF Experience podcast. Some of you may not have. I switched over from the ETF Experience to my own show under my own name for two reasons. The first is I wanted to be able to explore topics beyond the narrow focus of ETFs. And the second is I wanted to keep the show independent of my company, at the time Exponential ETFs, now Signal Advisors. But in making the switch, I lost about 2,000 regular subscribers, as well as an incredible archive of shows. Over the next couple months, I'm going to be bringing back some of my favorite ETF Experience episodes here. And I want to start with this episode with Aaron Brown. This was a very special show for me because Aaron Brown was my favorite college professor, and he's someone that I look up to as a true genius and a free thinker in the financial services industry. We talk about quantitative analysis, we talk about Bitcoin, and we talk about a lot more. So please enjoy this episode with Dr. Aaron Brown.
This is the ETF Experience Podcast, brought to you by Exponential ETFs. We'll take you behind the scenes of the asset management industry and talk to the innovators who are changing the way investors trade, invest, and build better portfolios. Here's your host, Phil Bach.
Welcome to the ETF Experience Podcast. We are at Hanger Studios in New York City, and my guest is Aaron Brown. Aaron is an author, a quant, and when I say quant, he is a true quant, an OG quant. He's the former risk manager of AQR. He's the developer of the Value at Risk metric. He's the author of several books, including Red-Blooded Risk and The Poker Face of Wall Street. He's a former professional poker player. We're going to ask him about that. He's a writer with Wilmot Magazine and Bloomberg and many other places. He's a teacher. He's a professor at NYU, formerly a professor at Yeshiva University, and a one-time professor of a pretty bad student named Phil Bach. Aaron, thank you for joining the podcast.
Thank you, Phil. Let me stick in two small corrections. I was not the developer of Value at Risk. There were a group of people who collectively did it. No one person is really responsible. And I'm an adjunct at NYU at the moment.
Okay. I thought we'd start off with teaching, with your teaching style, because I was a terrible student. I still am. And I think, I had a hard time concentrating and a hard time. I couldn't get past the concept that I didn't get a refund if I overstudied. If I pass a course or get a degree, that I probably dealt with some immaturity issues earlier in my life. And maybe I still do now. I think some of those skills that hurt me as a student probably help me now in business. But be that as it may, I loved your classes. You taught, I think, 3 classes at Yeshiva University, and I took all 3, despite my lack of success in the classes. But the reason why I like the classes is because you had a very clear love of numbers and investing, and you taught that way. It came out. It wasn't just, hey, here's a process for this is what a Fama French formula is or whatever it is. It was really taught from that place. And there were a couple of real examples that I still remember, and I remember very little from my college years, but a couple of things that I still remember to this day. One was, one day you came in with an advertisement, a full-page ad from the Wall Street Journal, and you had a copy for everyone in the class, and there were like 6 paragraphs of fine print. The advertisement was for a car lease. So for $250, you could lease this Toyota. And there were 6 pages of fine print. And all you did was you put on a whiteboard, on a blackboard, you said, I equals 3 or whatever it is, gave us the interest rate, and said, do I want to buy this car or do I want to lease the car? It was that kind of a hands-on, tangible way to teach where it's like, okay, we're going to figure out what is the smarter way to do. That's a puzzle. That's something that's fun to do. And through that, we learned all sorts of how to do net present value and all sorts of things that could have been taught in a very dry way. There was another one that I remember very well, which was a midterm exam where you told everyone to bring a laptop. And this is back before that was so commonplace. That was pretty forward thinking. But the test was very simple. We had our laptops, we had our Excel open. All you did was gave a handful of FX rates, and he said, find the arbitrage. Here's the sterling yen, here's the whatever it was, a whole bunch of them, and in there was the arbitrage, and we had to back into it. And it was really fun. It was really challenging. It was really fun. I remember that test. I failed it, but I went home later, and I solved it. It bothered me for a good 24 hours until I was able to figure it out on my own. Is that a deliberate teaching style that you have? Were those lessons that you sat and said, all right, how am I going to get these kids to really think about finance in a more practical and fun way? Or is that what happened to be on your mind at that moment?
I wish I could claim that I was a deep philosopher of teaching and that I'd done a lot of empirical research on what works in education. It isn't, unfortunately. I teach the way I like to learn ever since I was a kid. I love to look at numbers and say, can we find patterns here? Can we make some money? I read the newspaper from the back where there were the sports statistics, the horse racing, the stock things, and I'd look and I'd say, okay, how can I not really make money in those days? It was just, how can I find patterns and understand this? And I love the fine print. I don't care about the headline in the ad. It's okay, let's go down and see what they have to tell you, what's really true. I do want to pick up on something you said at the beginning about your attitude toward school. I don't think that's a bad attitude. I think a student who says, okay, I'm here to get a credential. I want to do it with the minimum effort. I don't really get any benefit from working hard and studying. I'm not saying that's great, but it's realistic that I think there's an opposite attitude, which is that if I work really, really, really hard and I do everything I'm told and I believe everything the professor says and parrot back the textbook on the exam, that I'm somehow going to be a great success in life. And that's more damaging. That's worse. Probably somewhere in the middle is best, somebody with a healthy skepticism, but also some respect for learning. But don't think of yourself as on the wrong side. Think of yourself as perhaps too far toward one extreme.
Well, it's very interesting that you, of all people, that you say that, because you have a very good pedigree and academic career from what I've read of your bio, but also you started at 14 years old becoming the road towards being a professional poker player. And you played poker from the time you were 14, played it in New York City poker clubs with adults. So you had both. You had real street smarts, hands-on learning, applying mathematical formulas to a game that you were playing that you needed to survive, which is just an incredible story and an incredible way to become eventually what's now called a quant or an investor. Can you tell us about that?
I wish I could say I was street smart. That would be nice. The kind of interesting thing is I did this without being street smart. I was the opposite. It was in Seattle, by the way, where I was doing this. But I was terrified of doing it. I was a very shy kid.
This is what happens when you have an independent podcast with no fact checkers. We're going to have the footnotes here so we can read those.
And it was incredibly difficult for me to walk into the base. It was a basement of a tavern. And in those days in Seattle, lots of taverns had basements or back rooms where there were poker games. And I had no idea if I would be kicked out. I had no idea if I would be beaten up and robbed. I had no idea if I would win. Actually, I was pretty confident about that. I'm perhaps irrationally confident about my ability to win in games and to calculate and do that. But I had zero confidence people would let me leave with their money. But they did. And there was no threats. Nobody was fine. I went in, I took their money, I left, and everybody, hey. Nobody said, where's your ID? Nobody says, who are you, kid? Shouldn't you be in school? And that was incredibly liberating to me because I wasn't street smart, because I didn't believe that. There are kids who are cool and confident, would naturally walk in, the Ferris Bueller type. And I was the exact opposite. I was like the nerdy friend of Ferris Bueller. But yet I could do it. And that's what was liberating. That kind of changed my life.
What are those skills that allowed you at that age to compete against other poker players?
Oh, that's pretty easy. I learned the game. I thought about, just reading book, learning the rules. I'd played as a kid like a lot of people, but kids don't play very well. I happened to have a friend whose father was a traveling salesman and played a lot on the road. And he was very interested in poker and gambling and so on, but knew no math. So we sat down, we talked about it. He gave me some tips on how it actually worked. I gave him some tips on math. I dealt a lot of You'd sit there, I would just deal hands, say, how would I play this? What would happen? That's the kind of preparation most people don't even do. You don't need a math PhD to do this. You just kind of think it through. How are you going to make money? What are the pots you can make money on? What are the different ways you can do it? And you want to be in hands where you can make a lot of money and you can't lose much. And you want to stay away from those pots where you can lose a lot of money and not make much. It's not rocket science.
And clearly a lot of parallels right there to investing. We'll get to investing in a little bit, but just to stay back with your earlier years, so you started your career and you were in the earliest days of what's now called being a quant. And I heard you say once that the word quant, when you started, was like an insult, and you guys took it on as like, we'll call ourselves quants, as the cool thing. Now, of course, there's nothing sexier on Wall Street than being a quant. What were those days like in your early days, and what was the perception of what a quant was?
Yeah. When I started, so I'm starting on Wall Street, so this is late 70s, early 80s, there was no word for quant. If you had a math background, you kept it off your resume. Nobody wanted any math people. So we come in and we start making money. We start doing some things. Certain areas of finance grow up, like mortgages and derivatives, where you need math. So it's not until the 90s. By the 90s, you have people on the trading floor making a lot of money, making real decisions, getting some power in the firm who were math people. And that's when they were derisively referred to as quants. If you wanted to be friendly, you called them a rocket scientist. Neither one of these were terms by quants. We don't tend to invent words like that, and we certainly wouldn't have said rocket scientist. But yeah, so quant was a disparaging term. Oh, they're just a quant. We got those quants. And it was kind of they're an annoying necessity. We need them around, but they're just, it's kind of like suits. There's people who are around. They're not really doing anything useful, but you got to have them. And yeah, it became adopted as kind of a term of pride in the late 90s or so. I honestly never used the term in either way until probably 10 years later when it was kind of accepted as just kind of, originally it's just a neutral term. Okay, that guy's a quant trader, that guy's a non-quant trader. And I think that's actually kind of the way it's gotten now. There was a period when quant was really cool, but I think that's kind of past.
You say that a big part of the quant job nowadays is to find new data sources or new ways of looking at the data or imperfections in the data. Kind of at the same time, we had this explosion in factor investing in recent years and the traditional factors, the Fama French factors. And then we get a couple of years where market cap weight goes on a run and you get a lot of this time's different arguments and, factors don't work. But is it possible that we've reached a level of crowding in those factors, or those factors have been so readily accessible that any edge has been arbed out? Is that a possibility?
I don't think so. I mean, the factors have worked over a century of data we have for them, and they go through periods of ups and downs. It is true that the last, I would say, 2.5 years or so are extreme, and there are some things that we haven't seen before, but they're not out of the ballpark extremes. So we're seeing a period that is not out of line with history, even though it is the extreme. Either things bounce back, we get back to the historical norm, and this is just a blip, or perhaps there is some change. But even if there's a change, I think what you're going to find is, and I think this is where most of the people who are doing research on this stuff are working on it, it's saying, okay, the basic factor is still, the basic economic argument for this factor hasn't changed. Momentum is still momentum. Value is still value. Low leverage is still low leverage. But perhaps people are crowding into the easiest way of measuring it. And therefore, what you have to do is you have to measure it better. Fama French, momentum is very simple. They just take the price a year ago, the price a month ago, they look at that return and they sort everything. So you say, okay, I'm not just going to look at price momentum, I'm going to look at earnings momentum, I'm going to look at book value momentum, I'm going to look at momentum by industry, by country, so I'm going to do a more careful analysis to figure out the true momentum that the market is rewarding. Because in the old days, you didn't have to do that. Anything with momentum was good because not many people were looking at it. As people look at it, they're going to get everything, including stocks with false momentum, and also they're going to miss some stocks that have true momentum that isn't showing up at the price over the period you measure it. So by measuring things more precisely, you can still get that edge. It's just more work.
We recently put out a podcast episode with Larry Swedroe, and he'd written a book where they identified 600 different factors. And to me, it's just the surprising thing is with all the data we have and all the data sources that we're not seeing more creativity about factors, that we're still relying on it. And of course, something that's tried and true and that's lasted different market cycles, I can understand that there's a level of comfort and efficacy there. But what surprises me is that there is so little creativity going into these models where people are looking at the market just from totally different ways. And you really don't see a lot of that.
Well, you got two different things. You've got academic factors and you've got practical factors. If you're an academic, you suffer under the extraordinary disadvantage that you can only look at very large portfolios generated by very simple rules over very long periods of time. That's why Fama French had to do a very simple version of momentum. They weren't trying to go out and find what's the best way to measure momentum in stocks. They were trying to say, because there's just too much chance for data mining. You can always find some momentum rule that works perfectly. So they had to pick something very simple. In that case, sort of the academic factor zoo, it just comes about that people want to get something published, and so you just, can sort through. You can find something that seems to work and publish it, and you can try 1,000 things, and so you throw away 999 of them, but who knows if the one that comes back actually works by coincidence or just data mining. In practical, you don't really care if you're data mining much. If you put in a factor that's random, that doesn't help you, it doesn't hurt you either. Maybe it adds a risk a little bit. Maybe it adds a little to transaction cost, but it's not a big deal. So you have a much lower threshold. So you can throw in all kinds of things that you're not sure they work, but you throw in 1,000 things that 10 of them work and 990 are neutral, you still have an edge.
What about the theory that the reason why market cap weighting is doing so well recently is because of all the money going in to index funds or direct indexing strategies or futures and options that track the broad indexes, that it becomes a self-fulfilling thing? The popularity of the market cap weight investment style is what's causing that return. Do you believe that to be the case? And if so, will we eventually get to a period of crowding where it diminishes the future return of that factor?
We've always seen that historically. There's a pendulum. Now, equal weighting or inverse weighting even more so. Inverse weighting does everything equal weighting does, but more so with respect to relative to market cap weighting. There's a mathematical advantage to it, and that edge seems to play out long term. So very long term with equal weighting, you get a small extra, maybe not so small. I mean, it's depreciable because of compound. It can add up to quite a bit. But over shorter periods of time, you get a pendulum, and you get a pendulum where market cap weighting does better for 18 months, 2 years, something, and then it swings back the other way. That almost has to be true. It is very difficult to imagine a market where one of those two always outperform the other. Whether it's cause and effect, I don't know. I mean, if market cap weighted indexes are doing better than equal weighted indexes, then yeah, more money is going into large cap stocks. Or is it because more money is going to large cap index stocks, or is it the effect? I don't know. I think there's a lot of factors in there. One of them probably is, if market cap weighting is doing well, more people are going to go for it. I think for a lot of people, indexing means market cap. So a lot of the money flowing in indexes just automatically goes to the market cap weighted indexes. As people are in index funds for a while, if you've been doing active stock picking for all your life, pension fund, for example, you've always had these active managers, and somebody comes along and sells you on index funds. That's a hard sell. But once they do it, you're going to go with S&P 500 index fund. Once you're in that S&P 500 index fund, 3, 4, 5 years, and somebody comes and says, hey, I got this thing that very highly correlated, similar pattern of returns, but gets you an extra 0.5% a year, gets you an extra 1% a year, and all it does is it equally weights. That is now a compelling argument that the guy couldn't have made 5 years ago.
It's very interesting to see the double-edged thing of popularity of different factors and strategies and how they affect the price, and then the other side of that. So then the crowding, and you look at now at low volatility, for example. There's been so much money coming into low volatility, and then you wonder, well, okay, if we hit that crowding point, then does that diminish the whole point of the return? It's almost like you want to be it's almost like you're making a bet on where the flows are going to go as much as you're betting on the strategy.
Two things. I don't think it's as big an effect as you suggest from that. The reason is stocks are incredibly close substitutes. Pick any 20 stocks at random and you're going to get pretty much the same return as any other 20 stocks. And if you select them carefully to balance out industry and so on, you get even better. So it's pretty high, even if 90% of the market is crazily changing allocations of this sort. It only takes a very small amount of money to equalize that. Kind of like a horse race. Everybody's betting on the horse race. Most of the money coming in has no information at all, and it's just people betting on the name or what they feel like or some crazy theory. But a small amount of smart bettors are going to go in there and take advantage of the undervalued and overvalued and equalize it. The biggest problem from flows is actually a little different, at least if you're a quant. When money is flowing into a strategy, it's not so much that it inflates the return, it dampens the volatility. So you're looking at this thing and you're saying, hey, if you look at a strategy over a period where money is flowing into it, you'll dramatically underestimate the volatility, and therefore you'll overlever it and you'll maybe get killed. Similarly, if you look at a strategy when money is coming out of it, it's not so much that you'll think, gee, it's not working, it's got a low return, but you'll overestimate the volatility. You'll be afraid of it. And so that's the important thing for quants to look at very carefully and be careful about.
It's almost like people set the equity allocation and then tinker with the volatility. They can just set the equity allocation within the whole portfolio accordingly and not have to tinker with the volatility.
Yeah, I mean, you can do it that way. That ideally, sort of in the theoretical sense, you go out there and you find your best Sharpe ratio portfolio, whatever it is, and then you lever it up or down to the right volatility. But getting the volatility right is incredibly important. People spend way too much time worrying about expected return. If you actually know your volatility, you can get very rich very quickly with a small edge. If you don't know your volatility, it doesn't matter what your edge is because sooner or later you're going to screw up and go broke.
Well, speaking of volatility, I know that you were an early investor in Bitcoin, which when you told me that, I was actually pretty surprised by it. I'm not sure why I was surprised by it, but I just was. I guess you got in very early on Bitcoin, and I'm sure it was appropriate to the volatility that you expected from Bitcoin in terms of the overall allocation size. But what was it that you saw early on in Bitcoin that you thought made it a viable investment?
Well, I've been really interested in what today are called cryptocurrencies, but in the older days people studied it from different perspectives since at least the late 80s, early 90s. It struck me as something that has to happen. And I thought about it at first kind of from an economic standpoint, that when people study economics, economists still argue about the basic nature of money. There's still nobody really has I won't say you can say everybody's got a theory or nobody's got a theory. There's no real consensus view on what it is or how it works like it is. But one thing that was obvious to me is the physical basis of the exchange was very important. People were using barter, people were using precious metal, people were using coins, paper money, or ledgers. I mean, in the major financial system, the traditional financial system today is based on ledgers. It's based on electronic entries, and ledgers replace paper ledgers. That this makes an extraordinary difference to the economy. The physical characteristics, so the technology by which people do these exchanges. And I think economics didn't seem to appreciate it so much. When they talked about the difference between paper money and precious metal coins, they talked about money supply and so on, and how that was different, and credit and how that was different. They didn't really talk about how that affects the entire attitude of people toward the economy, toward the kind of things they do. And it just seemed to me pretty clear that we now had the technology to do some form of money that didn't require a trusted third party and that allowed instant settlement. And once you have that, that's clearly superior to any other form of money. And so it has to take over eventually. And when it does, it's going to change a lot of things, and we can try and figure out and guess what those are. But when you say I was an early investor in Bitcoin, I was in 2012. So Bitcoin's introduced in 2008. I would say very few people in those days thought of themselves as investing in Bitcoin. They collected it, they played with it. And I originally got in it just to see, how does mining work? Back in those days, you could mine on your PC. And I started playing around with some of the other currencies. It wasn't until 2012 that I used cash to invest in, to actually buy Bitcoin. And I decided at that time that I think trustless peer-to-peer exchange is going to be something like 2% of the entire economy eventually. I want 2% of my portfolio in it. Incidentally, I made the same kind of calculation back in 1994 for the internet. And for the internet, I said 5%. And the internet ended up being about 7% of the economy today. So I was actually pretty good. But the thing I tell people is what's really important is to have a number. Sure, we don't know what it is. Cryptocurrency could be zero, could go to zero, might just be a flash in the pan, it might be completely erased by something else, or it could be 10% or 20%. But if you pick a number and you stick to it, it means you're buying when it's cheap and you're selling when it's expensive. Over the years, I've bought and sold many times as crypto has gone up and down, but I'm way ahead of the game by now because of this. Sure, if Bitcoin goes to $1 million tomorrow, then the people who bought and never sold are going to have made more money than I will. And if it goes to zero, the people who never got in, well, actually, I'll still be better off than them. I have made net profits. I'm playing with house money at this point on that. So the key is the less you know about the value of something, the more important it is to pick a number and just stick to it. The problem is people who, when it's going up, they get excited about it and buy it. So they were buying it in late 2017. And then when the price goes down, they give up on it and sell it. That's how you guarantee to lose money.
Based on your theory that there should be a peer-to-peer instant settlement currency, or there eventually will be, it's inevitable, should not the price be somewhat correlated with the usage or the number of transactions that are actually being used in the currency?
Well, that was the original valuation model for Bitcoin. Back in, I think it was 2012, I published something. I said, okay, we don't really know what it's worth, but here's the best I can do. Here's how I came up with my 2%. And that was based on the transaction value. So it said, okay, people are going to use this for transactions. Because of that, they're going to hold balances. There's a fixed supply. We know what balances people want to hold, so we can back into what number that should be. Obviously, it's now become clear that Bitcoin is never going to be that. On the other hand, the use case for cryptocurrencies has gone way beyond the peer-to-peer transactions. So there's a lot of different views. Today, when I look for value, I say, okay, forget about that transaction. That is merely one use case. That, in fact, we're not going to have, that crypto is not necessarily going to be the big general purchase thing. And if it is, it may well be a cryptocurrency run by a bank or a government. But it can facilitate all sorts of more complicated transactions or transactions people don't want to put into the basic currency. Things you don't want to buy or sell for money, but you do want to exchange in some way. So then I'm looking at all the different ideas people have for that. And there are thousands, of which I would say, there's certainly several dozen that have major obvious commercial appeal, have very strong economics, and have very strong development teams behind them. Many of them have no users. Many of them have not, gone to testnet yet. So it's hard to really measure how successful they're going to be based on anything other than hope. So again, it's kind of like the internet in 1994. You had companies that had no revenue. They had no idea how they were ever going to get revenue. But people were excited about them. They were good ideas. And you say, okay, I'm just going to have faith. This is a good idea. It's got smart people. One day people are going to figure out how to make it pay. Obviously, that's a lot riskier than a utility that's got recurring revenues and big assets. But if you don't want your portfolio to be outdated, you got to have some exposure to new ideas.
Yeah. I suppose also there's asymmetry of potential outcomes when you have 2% of your portfolio. You can stomach potentially a disaster with that just 2%, but the upside will compensate you so much for that potential downside as it came to pass.
Well, that's true, but if Bitcoin goes to zero tomorrow, that's one thing, or all crypto goes to zero tomorrow, that's one thing. But it's not going to happen. It's going to go up and down. And if you're buying and selling as it goes up and down, you're collecting money. So even if the whole thing eventually goes to zero, as long as you've maintained a steady allocation and you've been disciplined about buying and selling, you'll be ahead of the game.
The criticism about crypto or Bitcoin that there is no intrinsic value is the answer that everyone says, which I agree with. From the crypto side as well, you could say the same with fiat currency. You have the faith and credit of the government behind it, but that doesn't necessarily mean something, certainly not on an infinite timeline. And more, I think you can see that with stocks and bonds. I think there's an increasing disconnect between the intrinsic value of what stocks are worth, and there's an increasing disconnect from the credit risk of bonds while everything is trading on, narratives in the Fed and different kind of macro policies. At least it seems that way to me. I don't know if you agree with that assessment. Well, do you agree with that assessment?
Well, intrinsic value is not a useful concept, unfortunately. Intrinsic value is whatever people think it is. If you look at any age in history, pick some random year in history, there were things people believed, nobody questioned there was intrinsic value to them, that today people laugh at. And there are things that we ascribe intrinsic value to today that they would never have accepted. In one sense, nothing has intrinsic value. It is only worth, other than things you can directly consume, can of food, a coat that keeps you warm in the cold. Anything else depends on other people's actions in the future. And if you consider those actions predictable, so I know people will accept this dollar, I know the U.S. government will require it for taxes or whatever, then a dollar has intrinsic value. If you don't accept that, if you say, well, government could decide tomorrow that the dollars were worthless, the old blue currency conspiracy theory that the U.S. government has warehouses full of blue currency and they're going to declare the green stuff invalid, and that incidentally has happened in some countries, then you say, well, gosh, it's got no intrinsic value. To the extent crypto has intrinsic value, to me, it is the developers, the code base, and the users that it has today. And that is a valuable resource. What's hard is putting a number value on it, dollar value on it, because at the moment it's not generating the kind of revenue we can use to a discounted cash flow model. It's valuable. That code actually works. Those ideas are really good. People really do want to use them, but translating that into dollars is hard. So what I say, the problem isn't how much value does crypto have. The problem is how much can you sell that value for? And at the moment, that's just opinion, and it wildly gyrates up and down. But someday we'll know.
One of the most interesting things that you've written that I think about actually pretty often is a paper that you co-authored about pulling the goalie. And of course, that's a hockey concept, but you applied it to finance, and it really applies, I think, more broadly in different areas of life. It's almost like a mental model in some senses. Can you tell us a little bit about that paper and what your idea was that you wrote about?
For those of the people listening who aren't hockey fans, it's pretty simple. You get 6 skaters on hockey. Each team gets 6 skaters, and one of them is designated a goalkeeper, and the goalie stands in the net and tries to stop the puck from going in, and the other 5 skaters, they're called, even though everybody's wearing skates, but the other 5 are called skaters, and they try to put the puck in the other team's net. Near the end of the game, if you're behind, it's sometimes the case that you will pull your goalie, meaning you'll replace the goalie with a 6th skater, which obviously increases the chance that you'll be scored upon, and it does it by a lot. It makes about 4 times as likely that you will give up a goal. but it also makes it much more likely you will score. So it increases the variance. Normally, early in the game, that would be a bad idea because you're giving up more expected goals than you're getting. But near the end of the game, you don't really care because losing by 3 goals is no worse than losing by 2. And if you can score, you can get closer. So the question is, when do you pull your goalie? At what point is the game lopsided enough? Are you behind enough that it's worth taking that increase in variance? And we modeled that, and we came up with a figure that was much earlier than NHL teams actually do pull the goalie. Typically, traditionally at professional hockey, and this is, so I'm talking about, say, from the time pulling the goalie became pretty regular in the 80s to maybe 2010 or so, was 1 minute. That if you were under a minute, if you were behind in the game, you pulled your goalie. In the last 10 years, it sort of gradually creeped up. So you're seeing some teams do it as early as 2 minutes. Average is about 1.5 minutes. But it should be 5 or 6 minutes. And that's if you're down by 1 goal. And if you're down by 2 goals, it should be 10 or 12 minutes. So the question is, why don't people do it? And it's not because they're stupid. It's not because they're not rewarded for winning. Not because they don't have a simple case where they have lots and lots of reputation. If you're a hockey coach, you can just look at the data. You got hundreds and hundreds of games you can look at. So you can't be confused about what the probabilities are. And the difference between a winning coach and a losing coach is a celebrity multi-million-dollar contract and being unemployed. So you would think there'd be tremendous pressure to get it right, and yet they consistently don't. And quants have been saying this for about 30 years. By the way, we were by no means the first people to say this. This is one of the common conclusions of any quantitative person who looks at hockey. And people have used lots of different kinds of models. They've used different data sets. And they've all come to the conclusion that they just do not pull enough. So why don't they do it? And we go through some of the reasons. The big one is coaches are not rewarded for winning. Coaches are rewarded for being thought of as a good coach. And there are a number of consequences of that. But one of them is, if you win in a controlled way, if you're switched to basketball for a moment, if your team runs disciplined offensive plays, they look really crisp, they pass around a lot, they get a lot of layups, and yeah, sometimes they don't get the shot off, and then they lose by a little. Well, you're a good coach and your players just didn't quite measure up. If you have your team, they're running gun threes, and they actually score more points that way, you're out of control. You don't control your team. You were just lucky. Maybe they won, but you're not a good coach. Another thing is hockey, at least professional hockey, is ultimately not a sport, but an entertainment business. If teams optimally pulled their goalies, we'd have a lot of 9-2 blowouts. A team would be down 3-2 at the beginning of the third period. They'd pull their goalie, then they'd get another, whatever. And the games would be much fun, and the fans would start leaving as soon as the first empty net goal was scored. As soon as a team pulled their goalie and a goal got scored, there's only 5 times in NHL history has a team ever tied or won a game after that point. Nobody watched the third quarter. Whereas now, even if the game is statistically hopeless, a team is down 5-2 and there's 10 minutes to go, the fans will be there cheering. They'll still be, they could win, they could pull it out. So anyway, the real point of the paper is you got to look at incentives and you've got to figure out why people are doing what they're doing, not just tell people they're stupid.
I love that framework because, like you said, what the coach is playing for is not necessarily to win as much as to be considered a good coach. You see that in the corporate world, everywhere in the corporate world, where it's all about image and being seen like you're doing well because your contribution to the bottom line of the company, it's just a drop in the bucket. Everything gets all mixed in together. And if you can position yourself to take credit for the wins and not for the losses or to avoid, that's, I think, how a lot of the people who end up surviving and thriving in that environment and end up at the top because they have those skills, that's how they operate. And what I love about being an entrepreneur now is our ability to play for the win or to pull our goalie. So we can say something controversial on social media if we think it's appropriate. We can swing a little harder. We can do those things that we think will have the net result that we're going for, that will have a return, that will get us where we want to be without having to say, well, yeah, it might be the smart thing to do, but we won't look like good guys or we won't look good in the boardroom or we might step on somebody's toes. We're free to pull our goalie. And I think about that often because it's just, hey, are we not pulling the goalie here because we can't risk having egg on our face? We can't risk getting a blowout. It's the smarter thing to do to just pull the goalie and go for it. And we're going to act without fear and with conviction because we have determined that to be the smartest play at that moment.
Yeah, let me tell you a story you may have heard. A guy named Alfred Winslow Jones. This is right after World War II. He invented the first hedge fund. He's a journalist, no financial experience or intuition, but he figured something out. He figured professional money managers at the time were not rewarded for beating the market. Nobody tracked whether they beat the market. Their clients didn't want it. They got a fixed management fee regardless of performance. And really, nobody was trying to beat it. So he did something very simple. He went to all the Wall Street analysts. And by the way, the laws on insider trading in those times were nothing like what they are today. It was entirely routine for corporate managers to tell favored analysts major inside information and for those favored analysts to pass it on. But they didn't do it because nobody was trying to beat the market. So Jones went to them and he said, okay, give me your best ideas, good and bad. So I, short the bad, I'll buy the good, and I will keep track of my investment returns on the recommendations you give me, and I will reward your firm in the form of directing commissions. And this was fixed commission days in exact proportion to the money you make for me. So suddenly the analyst's job, as far as Alfred was concerned, was to beat the market, was to find good stock picks. And the analysts knew what the good stocks were because the CEOs told them. And so the fund made tons and tons of money. So this isn't rocket science. It's just understanding incentives and making money. And this is why we have hedge funds today. And by the way, a lot of things hedge funds do today are no more complicated. They're just figuring out where does no one have an incentive to make money? I'll just give them the incentive.
Now, you spent many years in the asset management industry with AQR, of course, who has hedge funds and mutual funds. The asset management industry today is having some tough times. So in the hedge fund industry, we've had 5 straight years of more closures than new launches. The mutual fund industry is under margin pressure. They have a lot of assets leaving towards ETFs. I think their troubles are being masked a little bit by market impact and a very good stock market for now. But I think there's certainly some big sea changes on the horizon and that we're already starting to see, and I think a lot of people are starting to see in the mutual fund space. In the ETF space, we've got really bad margin pressure right now. There was this fee war, and it's very, very difficult to reach a level of scale that these funds can become profitable at their current cost structures at. It's tough times right now in the asset management industry, by and large. Having been for a long time in the asset management space, is this something that you thought was inevitable as the product vehicle or the idea of a product vehicle became commoditized? And do you think it's a valley, but there will be a bounce back? Or is this, do you think, a trend that will continue in the asset management space?
In business, there are no tough times. There are opportunities. What people call tough times are the old ways aren't working. And what I did yesterday isn't making me as much money as it did today. And that means somebody else somewhere is making more money, is coming up with new things. Historically, and let's go back to, say, the 1970s, so we're talking early 70s, we're talking before index funds, we're talking before a low fee, we're talking commissions are still fixed and so on. The asset management business was, we just have to say it, the asset management business was just cheating people, was just taking a fee for doing nothing and taking big fees. And investors could not actually, under those old rules, with high sales loads, with high fees, with random closet indexed portfolios, investors could not make any return above inflation and taxes. Because remember, you got inflation is pushing up the return. You're paying taxes on the nominal return, including inflation. So what you're left with was frequently zero, sometimes negative. Anyway, it was not significantly positive. So it's good that it was tough times for those people. It's good that index funds came along, fees went down, and you started having to you had to beat the market to get paid. Now, those are very, very slow things. We still have sales load funds. We still have funds that are closet indexing and charging high fees, but they are being replaced. But what that means is more opportunity for ideas that actually help people beat the market. And I think if you're in the asset management industry, this is what you want. You want to be rewarded for actually making life better for people, for actually helping your clients. You don't want to be rewarded for tricking them into giving you more money for doing less work. We're seeing a lot of smarter people going into the field. We're seeing a lot of new ideas come around, and I think we will see tremendous amount of change. But those firms that are genuinely serving their clients, those people who go to work in the morning and say, okay, how can I help my investors? Those people are going to succeed. And the people who are going in and saying, how can I keep this gravy train running a little farther and, keep extracting my fees for another couple of years, those people are going away. Those people have suicided. They haven't been killed by tough times. They've decided to take themselves out of the competition.
Aaron, I like to ask this closing question of all my guests. Tell me about an obstacle that you've had either in your life or in your career that you've either found a way to work around or persisted through.
Well, I don't know exactly how you'd call this an obstacle. I am by nature antisocial. I'm by nature shy. I'm by nature kind of think if I enter into some interaction with some stranger, I have to call somebody on the phone, I have to go meet somebody, whatever. I'm far more aware of the negative consequences than the positive ones. So I'd rather stay home and read a book. I'd rather play on my computer and find some new mathematical pattern. I love doing math. I'll just sit around for 3 days and work on a math problem or something. And I figured out very young that would be a crippling disadvantage if I didn't get over it. Unless you happen to get a job at the Institute for Advanced Studies where you could just sit around and think and people would pay you money and take care of you, you had to go out and meet people and work and so on. So I had to force myself to do it. And it was very hard. And it's actually kind of doubly hard in the sense that it's hard to force yourself to do it. And then when you do it and it works, you tend to get euphoric and you tend to err in the opposite direction. You think everybody loves me. I'm going to, all I have to do is say this stuff and everybody's going to love me. So I have had a rockier emotional career than you might think. Look at my bio. You look at my bio and it says, okay, here's a guy steadily progressing, doing what he likes, being successful at it mostly. And compared to most people, I've had a lot fewer obstacles in my life, a lot fewer hardships in terms of, health problems, in terms of major financial reverses, in terms of scandals, disgraces, loved ones having problems and things like that. But I think I feel them more intensely than a lot of people. I think emotionally, I feel like I've had a rocky, tempestuous life, even though anybody looking at a movie of it would say, yeah, it was a pretty comfortable, steady life. I don't know if you can really call that an obstacle. It's kind of who I am. And if I weren't that way, I probably would have settled for a more conventional, more comfortable life. So I don't know. But yeah, I would say that realizing very early on in life that I had to force myself to do some things I didn't like, that's something I faced. I don't know that everybody faces it. Obviously, lots of other people do. But I think there are people who don't quite have that so much. You kind of feel like I can act the way I feel like acting. I can kind of let my feelings and dictate how I act, and things go okay. And if you're sort of more conventional, that really works. It didn't work for me, so I had to pick something different.
And made it work, to incredible success in your career, of course. I mean, I could say firsthand as a professor, my favorite professor. And I said that all along, and the only professor that I've kept up with, I didn't for many times. I didn't even know that we were in the same industry like that, and that you were an author and everything else, and kind of legendary in this small world. So to tremendous
Not so
success.
Small world.
That's right. So I think that's a beautiful place to leave it off. Thank you so much for joining me. Where can people keep up with your writing?
Thanks, Phil. They can read my Bloomberg column, which is available either on the Bloomberg terminal, if you've got that, or on the internet. Wilmot Magazine's a little more obscure, but if you're a financial quant, you should definitely look into it. It's a great magazine for that. Got a website, eRater, and then the word Rater.com, where I post stuff.
Well, thank you again. Thank you for coming on the show. Thank you to our audience for your time and attention. Please rate the show if you're so inclined, and we'll be back with a new show next week.